Hello friends, myself Dr. ABHISHEK. In this video, we will discuss about valuation or pricing of the bond. So in this video, we will discuss number one concept of this topic, number two, the relationship between interest rate and price of the bond, number three, we will do two numericals, one numerical with annual interest rate, second numerical with semi-annual interest rate, and number four, we will prepare a graphical representation also to understand the relationship between interest rate and price of the bond. So to understand the total concept was the video till the end. Let's start. Pricing of the bond. Pricing of bond uses the principle of discounted cash flow. If you remember, while doing time value of money, there were two methods. One was present value method, second was compound value method or future value method. So while calculating the price of the bond, we always uses present value method, which is also known as discounted cash flow. The cash flow of a conventional bond consists of two parts. Number one, the periodic coupon payments, and number two, the final redemption payment, and are fixed at the time of issue itself. What it means? Pricing of valuing of bond is relatively easier than valuing the equity shares or derivatives, because in case of equity shares and derivatives, return was not certain, but in case of bonds, these things are certain in case of a conventional bond, because you know in the future how much interest you will get, as well as at the time of redemption what amount you will get. So it is comparatively easy. There is inverse relationship between the price of the bond and the discount rate. These two lines are very important, because the total concept of pricing of the bond depends on this. What it means? It means higher the discount rate, lower the price of the bond, and lower the discount rate, higher the price of the bond. What it means? Okay, I tell you with one example. Suppose today I purchase a bond which is paying 10% rate of interest. Fine. After some time, suppose rate of interest decreases in the market to 8%. Now what will happen? Now everyone would like to purchase my bond because it is paying 10% rate of interest. So because of the more demand, now the price of my bond will increase. Fine. Up suppose reverse happens. Now in the market, if the new bonds are paying 12%, but my bond is paying only 10%. So now what will happen? No one would like to purchase my bond. So what will happen? If I want to sell my bond, I have to sell at a lower price. So that's why we say higher the discount rate. Discount rate means here basically the interest rate. So in other words, you can say if the rate of interest increases in the market, then the price of already issued bond decreases, and if the rate of interest decreases in the market, then the price of already issued bond increases. We will discuss this with one example also. Suppose Mr. A invests in a bond of rupees 1000. 7% is a coupon rate. Coupon rate means interest rate. 5 years to maturity. This is the life of the bond. The market yield on such type of bond is 8%. So market yield means कि nowadays the new bonds are paying 8% rate of interest. So what will be the price of the bond? So to solve this type of question, we will prepare the table. So in the table, the first column will be year, time t. So year 1, because the life of the bond is 5 years, so I have written here 1, 2, 3, 4, 5. Then cash flow. In the first year, I will get 70 rupees as interest. 1000 is the face value of the bond, 7% is the coupon rate. So 1000 into 7% is 70 rupees in the first year, 70 rupees second year, 70 rupees interest in the third year, 70 rupees interest in the fourth year, and in the fifth year I will receive 1070 rupees. Why? Because on maturity I will get 1000 as the principal amount on redemption, as well as 70 rupees as a interest. So in the fifth year I will get 1070 rupees. Because the market yield is 8%, so I will take the present value factor at 8%. There are two ways to get these values. One way is you can take from the present value factor table. In any of the book of financial management, security analysis, you can get these values. Second option is you can calculate through calculator also. So 1 divided by 1 plus r to the power n. This is the formula. So in this case, it will be 1 divided by 1 plus 0.08 to the power 1 for the first year, to the power 2 for the second year, to the power 3 for the third year, in this way. And then we will multiply cash flow into PV factor. If we multiply both these, so we will get the present value. How we get? 70 multiplied by 0.926, 64.82. 70 multiplied by 0.857, 59.99. 70 multiplied by 0.794, 55.58. 70 multiplied by 0.735, 51.45. And 1070 multiplied by 0.681 is 728.67. If I add all these values from here to here, so we will get 960.51, which is the value of the bond. So in this way, it is quite easy to calculate the value of the bond. So in this question, we are assuming that the company is paying interest annually. Now let us do one more question in which if the company is paying bond semi-annual interest, because most of the bonds pay interest semi-annually. So what we will do in this case? To value such bonds, number one, interest payment must be divided by 2 to obtain the semi-annual interest payment. So suppose if we are getting 70 rupees in 1 year, then in semi-annual case, we will get 35 rupees after every 6 months. Number 2, the number of year to maturity must be multiplied by 2 to get the number of half yearly periods. It means if the life of the bond is 5 years, but we are getting semi-annual interest, so in 5 years you will receive the interest 10 times. So that's why we multiply the year to maturity by 2. Number 3, the discount rate has to be divided by 2 to get the discount rate applicable to half yearly periods. So like in this question, the market yield was 8%. So here we will take the market yield as 4%. So Mr. A invests in a bond of rupees 1000, 7% coupon rate, 5 years to maturity. The market yield on such type of bond is 8%. So what will be the price of the bond if interest is paid annually? So everything is same, only I have taken interest as semi-annual. So how to do it? In the same way, period 1 to 10, because now in 5 years we will get interest 10 times. So I have written 10 times. Cash flow, in every 6 months I will get 35 rupees because it is a 7% coupon bond. So 7%, 70 rupees we will receive in 1 year. So in 6 months I will receive 35 rupees. So 35, and in the 10th period I will receive 1035. 1000 for the principal amount of the bond and 35 for the interest payment. Then I will take present value factor at 4%. In the same way as we discussed previously, either you can take the book, help of the book, from the table you can take, or through the calculator also. 1 divided by 1.04 to the power n. And then you multiply cash flow into the PVF. So you will get the present value. And if you add all the present values, you will get the value of the bond. And we can cross check also, because in this case, the company is paying 7% rate of interest, and in the market rate of interest were 8%. So because rate of interest increase in the market, that's why the value of the bond has decreased. Fine. Let's proceed further. So value of bond and discount rate, there is an inverse relationship between the price of the bond and the discount rate. Higher discount rate means lower price and vice versa. It means if the interest rates in the market will increase, the market value of the bond will go down. And if the interest rate decreases, the market value of the bond will increase. So this relationship is very important to understand the total concept of this topic. Now we did discuss the graphical representation. So in this graph, you can check that when the rate of interest is 12%, this graph is not belong to this question. This is a separate graph. So if the discount rate or the interest rate you can say is 12%, the value of the bond is 100 rupees. if the rate of interest increases in the market, the value of the bond is decreasing, and if the discount rate is decreasing, the value of the bond is increasing. One more important point to understand here is, you can see this line is not a linear line. So it means the relationship is non-linear nature. It means if you check, if rate of interest increases from 12 to 13%, the price decreases by 5.43 rupees. But if rate of interest decreases, then the price increases by 5.89. So it means there is not a linear relationship between price of the bond and the discount rate. So I hope I'm able to understand you all these concepts, the relationship and the graph. Thank you. Have a nice day.